A middle-class money trap is different from a middle-class money mistake. A mistake is something you do wrong. A trap is something built to make you do the wrong thing and to make it feel like the right thing while it's happening. Today, we're going through four financial systems that are specifically designed to take money from middle-class earners, not by accident, on purpose, with testing and profit projections and decades of refinement behind them. There is a room in every car dealership in America that costs the average buyer $1,581 more than they planned to spend when they walked in. Most people don't realize what's happening in it until they are already signing the paperwork. I'll show you exactly what that room is and what goes on inside it. But first, the number that explains why these traps work so consistently. 89% of car buyers use the financing arrangement offered by the dealership. Not because dealership financing is the best rate available, because the dealership controls the information, flow, and the timing. You've spent an hour negotiating the car. You're retired. You're excited. You just want to get home. And then you walk into the room. Trap 1. The car dealership F&I office. F&I stands for finance and insurance. Every dealership has a dedicated department for it. It's where you finalize your loan and where a finance professional presents you with a menu of add-on products. It's also where the dealership makes the majority of its profit per vehicle sold. Here's what most buyers don't know going in. The car salesperson and the F&I manager are two separate profit centers. You already negotiated the car price. That negotiation is done. The F&I office starts from zero. And the products they offer carry margins that would make most retailers uncomfortable to discuss openly. Let's go through the main ones. The financing rate. When you finance through a dealership, the dealer submits your credit application to a bank or lender. The bank comes back with what's called the buy rate, the lowest interest rate the bank will approve you for, based on your credit profile. The dealer is then allowed to mark up that rate and keep the difference as profit. This markup is called the dealer reserve. I want to be upfront about the number I'm about to cite because the data here has real limitations. The exact average profit a dealership makes specifically from financing rate markup varies significantly by dealership and is not tracked in a single consistent public database. The $850 per vehicle figure I'm using comes from industry benchmarking sources, not independent auditing. The direction of the number is accurate. Dealers do profit from this markup, and the amounts are material. Treat the specific figure as approximate, approximately $850 per vehicle in average financing profit. On top of the car sale, the fix. Get pre-approved by your own bank or credit union before you set foot in a dealership. Walk in with a rate letter. Now, dealer has to beat your rate to earn the financing. Most of the time, competition closes the gap. Gap insurance. Gap insurance covers the difference between what you owe on the car and what the car is worth if it's totaled in an accident. It's a real product with real value, particularly in the first 2 years of a new car loan when you owe more than the vehicle is worth due to depreciation. The trap is the price. Dealerships charge $400 to $700 for gap insurance, which gets added to your loan balance, meaning you pay interest on it for 72 months. The same coverage through your regular auto insurance company costs $20 to $40 per year. Industry data shows the dealer's cost to provide gap coverage is approximately $50 to $100. That is a 400% to 600% margin on a product you can buy elsewhere for a fraction of the cost. The fix. If you want gap coverage, and in the first 18 months of a new car loan it can make sense, call your auto insurer and add it there, not at the dealership. Extended warranties, also called service contracts, carry profit margins of 50% to 70% at the dealership level according to multiple industry sources. The dealership purchases them wholesale and sells them at a significant markup. Here I want to give you the full picture, because the blanket, never buy extended warranties advice that circulates in personal finance content isn't always correct. For certain product categories with high documented failure rates in high-use households, some major appliances, HVAC systems in extreme climates, Consumer Reports data shows claim rates that can justify the purchase. The problem isn't extended warranties as a concept. The problem is buying them from the party with a 50% to 70% margin baked in. If you want one, shop it independently. Stop for a second. I know what some of you are thinking. I already know about this stuff. I'm too smart to walk through an F&I office and not notice what's happening. Maybe, but 89% of car buyers still use dealership financing. That number includes smart people. It includes people who read about this beforehand. The F&I process is built to work on tired, excited people who have been negotiating for an hour. Knowing the trap exists and not getting caught in it are two different skills. That room I mentioned at the start. The one that cost the average buyer $1,581 they didn't plan for. Weary's still in it. Here's the number that makes it all concrete. The average F&I department generates $2,001 in profit per vehicle sold, according to industry benchmarks. The car itself generates a front-end gross of $1,200 to $2,000 on a new vehicle at today's compressed margins. The financing, the insurance, and the add-ons generate more profit per deal than the car does. You are not the customer in the F&I office, you are the revenue. Trap 2, the credit card minimum payment formula. Credit card minimum payments are calculated to be just large enough to prevent a missed payment fee and just small enough to keep you in debt as long as possible. That's not cynicism, that's the actual design of the formula. On a $6,000 balance at 22% APR, the minimum starts around $120. Pay only the minimum every month, and you clear the balance in approximately 27 years and pay roughly $8,700 in interest on top of the original $6,000. 27 years. That is the trap, built into a payment amount that feels manageable. Trap 3. Buy now, pay later, and rent to own. Buy now, pay later products are marketed as interest-free. Many technically are if you pay on time. Miss a payment and the late fees on some BNPL products function as an effective APR of 20% to 30%. But the bigger issue isn't the late fees. The issue is that BNPL creates invisible monthly commitments. A $150 purchase becomes 4 payments of $37.50 across 2 months. That feels like nothing. 4 BNPL purchases creates $150 in monthly commitments spread across different apps and different billing dates. At a $600 discretionary margin, that's 25% gone to past purchases before you've bought anything this month. Rent to own is the extreme version. Effective APRs on rent-to-own televisions and furniture regularly exceed 100% when you calculate total payments versus cash price. A 500 television can cost $200 or more in total rent-to-own payments. The room in the car dealership I mentioned at the start, it's the F&I office. Now you know what's in it. None of these traps are hidden. The paperwork is all there. The products are real. But the information asymmetry, the gap between what the seller knows and what the buyer knows in that moment, is where the profit lives. The defenses are specific. Get pre-approved before entering a dealership. Buy Gap through your auto insurer if you want it. Shop extended warranties independently if you need one. Pay more than the minimum on every credit card balance every month. Count BNP payments as real monthly expenses before you take them on. None of these require a financial degree. They require knowing the room exists before you walk into it. Which of these traps have you walked through? Not rhetorically, specifically. Drop it in the comments. The F&I office? Minimum payments for years? BNPL adding up quietly? I want to know which one is hitting people hardest. Next week on EMP, we're going to talk about why you can build an emergency fund on a middle-class salary, and what actually works when the standard 3 to 6 months advice is completely disconnected from your real margin. Subscribe if you don't want to miss it.